What's up, guys? Welcome back to DCA. Tonight, what we're going to do is talk about market cycle theory. So, in my opinion, this is one of the most important videos that I've done since starting my channel. The reason for this is that Bitcoin is right now sitting at a critical price level, right at around $46,700. We've obviously come down over $20,000 now from our peak, which was at around $69,000. Okay. So the reason we're going to be talking about market cycle theory is because we're seeing a lot of discourse online right now talking about, you know, is this a 4-year market cycle? Are we going to experience lengthening market cycles? And so we're going to clear up some of the confusion about these two theories. I'm going to make this a two-part video. So in the first video, I'm going to discuss lengthening market cycles. And in the second video, I'm going to discuss 4-year market cycles. I want to do this because I feel like there are a lot of misconceptions, spreading about specifically the lengthening cycle market theory. So the reason I'm going to discuss these topics tonight is because I feel like, on social media, on YouTube, on Reddit, on Twitter, etc., you're seeing a lot of discourse now talking about, oh, is this a 4-year market cycle or is this a lengthening market cycle? And people are acting in a way such that this must be a lengthening market cycle. Okay. So I'm going to discuss my personal opinions on this, and I'm going to point out some of the serious flaws in the manner in which people are approaching this lengthening market cycle theory. So let's just get this out there, guys. With regards to 4-year market cycle theory, I do not believe this theory is correct. I think there are serious flaws in the way that this theory is constructed. I think there are some very simple oversights that go into this theory. And I think that a lot of people that believe in this theory are ignoring some very basic facts about the way that markets work. So I'm going to discuss that in further detail in tomorrow's video. With regards to lengthening cycle theory, personally, I do subscribe to lengthening market cycle theory. However, I also believe there are serious flaws in the way lengthening cycles are being discussed by some of its most popular proponents on YouTube, and B, by many of these YouTubers' disciples, let's call them, people that really believe in this theory, and they're blindly ignoring some larger macroeconomic perspectives. So tonight we're going to discuss how lengthening market cycle theory, as it's popularly being discussed on social media, on YouTube, on Reddit, on Twitter, etc., how there are serious flaws in the way that it's being talked about, and how, in my view, you should be thinking about 4-year and lengthening market cycle theories. So if you're unaware, lengthening market cycle theory suggests that the time from a market cycle bottom to the market cycle peak will tend to increase over time. Okay, so the most common way that this theory is discussed ignores the halving event. Okay, so in essence, it basically says that, from wherever the market cycle bottom is, that will be the start of the market cycle, and the peak price will be the top of the market cycle, and that will comprise essentially one market cycle. All right. And the theory states that over time, this will increase. So, for instance, if we go from this bottom up to this peak, that's about 740 days. Then, if we go from this next market cycle to the peak, that's about 1,072 days. Then you can go from this bottom up until this peak that we had out here, and that's about 1,063 days or so. Okay, so I've basically put onto a chart the length of each market cycle from bottom up to its peak, all right? And you can see that the first market cycle wasn't very long. It was about 250 days. The second market cycle, so this is going to be your late 2013 market cycle that peaked in about November, it was about 750 days. Your market cycle that topped in 2017, in December of 2017, that's here right at around 1,050 days or so. And then our current market cycle, it hit its peak right at about the exact same quantity of time that we hit our peak back in 2017. However, lengthening market cycle theory then suggests that this fourth market cycle in yellow will continue and we will go on to make new all-time highs. Now, this is the first major flaw I'm seeing. Just because, let's say from a bottom to a peak, this market cycle were 10 days longer than the third. That does not indicate a lengthening market cycle. And I'm reading numerous articles as I was, doing some research, as I always do before I make any video, doing some research online. Many people are saying that this confirms lengthening market cycle theory because the market cycle has lengthened by 10 days. That does not mean, that does not validate any theory. And recall, I personally believe in lengthening market cycle theory. When we say lengthening market cycle, we don't mean 10 days. We don't mean 50 days. We don't mean probably even 100 days. That's all within the margin of error. We're talking about 6 months, a year, or longer. 10 days, 20 days, 50 days, probably even up to 100 days. I guess, if you start getting up to 150 days or so, there's no hard definition, but I don't think anyone seriously considering this theory and thinking about it from a mathematical or a scientific or an economic perspective is implying that a 10-day increase or a 5-day increase in the length of the market cycle confirms or validates the theory, because it doesn't. It just simply doesn't. Okay. Being 10 days longer is much closer to a 4-year market cycle than than being a lengthening market cycle, for instance. Now, my issue with the way that the theory is presented, the second big issue is, the way the theory was sort of derived in the first place by its most popular proponent on YouTube was by simply looking at, okay, so this to here, this increases by X amount. And then from this to here, this increases by Y amount. So therefore, because we have two data points, there is lengthening market cycle. And that's not how it works. And I'm certain that the individual who popularized lengthening market cycle theory is well aware of the fact that two data points makes not a trend, my friend. Okay? So you cannot come up with a theory saying that there are lengthening market cycles because you have two data points alone indicating that there are lengthening cycles. And if you personally are not in the sciences, if you don't work with statistics, this may not make a lot of sense to you, but this simply is not enough scientific evidence in order to make the conclusion that there are lengthening market cycles. Now, on the other hand, you might be asking then, what would make, or what would be enough evidence, or what things would be suggestive of there being lengthening market cycles? And this would simply be if we look at other asset classes. If we look at broader markets, so NASDAQ, S&P 500, and we go back in time and look at those markets. And in fact, if we do that, we do see that over time, in general, there has been a broadening of the length of time between market cycles. Okay. So, the market cycle as it's presented here, saying that because the first cycle, went to the second and that was longer, and the second went to the third, that was longer. Therefore, all future market cycles must be lengthening in time. Okay. That simply does not hold up to, scientific or statistical evidence required in order to come up with a valid theory. So, like I said, you need to go and look at other asset classes. And if you do this, in fact, you can see that as an asset class matures, in general, the market cycle do increase in time. Okay. So This brings me to the next point. When we say lengthening market cycles, and this is the part which I think is most important and people truly need to pay most attention to because, you know, the way that I'm seeing it being discussed right now on social media, like I said, specifically on YouTube, on Reddit, and Twitter, people are saying, I believe in lengthening cycle theory. Therefore, I have no doubt in my mind that the price of Bitcoin is going to recover from where it's at now, which if we go back here, we just come in closer. I have no doubt in my mind that Bitcoin is going to recover in price. Okay. And, you know, that's highly problematic. The reason that that is problematic is because lengthening market cycle theory need not apply to any individual market cycle because it's simply when you're saying, as a matter of fact, this market cycle must lengthen in time. That ignores all outside exogenous macroeconomic factors that go into the price of Bitcoin. It ignores the stock market. It ignores securities, equities. It ignores the Fed, looming specter of interest rates rising in 2022. It ignores things like, COVID, the recent occurrence of the COVID outbreak. We're seeing more cases of COVID per day now than we were at its peak last January. It ignores things like this. If you say to yourself, this price must recover because someone is telling me there are lengthening market cycles and therefore I believe that theory, you're setting yourself up for absolute disaster because there can be exogenous factors affecting the price of Bitcoin, which will definitively take it down at least in the short to midterm. And when I say short to midterm, I'm talking about 1 year or more, okay? 1 to 2 years, that sort of range. When we're talking about long term, we're talking about, 4 years, 5 years plus. So if you are saying this market cycle must lengthen, it's simply an erroneous way of thinking about the market because markets don't act in a vacuum. The price of Bitcoin, the price of altcoins do not act in a vacuum. Things outside of the cryptocurrency asset class have a direct effect on the price of Bitcoin. Bitcoin and the cryptocurrency assets like Ethereum, all of the altcoins, etc., these are risk on assets. And if you're unfamiliar with this term, what that means is a risk on asset is, in its most simple terms, is an asset which people will acquire because of the expectation of high returns or high profit. They will take on these assets during strong economic periods because they are expecting high returns. But when there are times of economic uncertainty, the first assets that people will remove from their portfolio, and when I say people, we're talking about institutional type investors. We're talking about super high net worth, commonly referred to as whales. We're talking about these types of individuals. They are going to remove risk on assets from their portfolio first in the setting of economic uncertainty. And if you don't think interest rates rising in 2022, all-time high levels of COVID, a potential real estate crisis in China. So if you don't think that these are economically uncertain times, then I truly believe you're ignoring the big picture. This does not indicate that, this must be the end of the market cycle, but it does indicate it's at least something you need to consider the possibility of and prepare for. You should at least consider the possibility the price does not return to where it has been, back in May and in November. And you may consider that this just could continue down into a longer term bear market. And ignoring that fact, based on what we know about the overriding macroeconomic picture, ignoring that fact is very dangerous just because someone is telling you that there must be lengthening market cycles occurring right now. Because at the end of the day, like I said, I do believe in lengthening market cycles, but that doesn't mean any individual market cycle must lengthen. It only means that over time and on average, they will lengthen. Outside factors influencing the market can simply send the market into a bear market at any time. There is no, mysterious force out there protecting the crypto market from what's going on outside. I believe market cycles are lengthening. I'm not saying that this market cycle is definitively over. I'm only saying there are outside exogenous factors that you have to consider. At the end of the day, there are hundreds of YouTube channels in the echo chamber telling you, everything's great. We're going to the moon. Institutions are onboarding in January. Don't worry. It'll be 55, 75, 100,000 in January. And then in February, just wait until February. We're going to 200,000 in February. There's a million channels out there telling you that. You don't need another channel telling you that. The entire basis of my channel is not to be bearish because I'm extraordinarily long-term bullish on crypto. The point of my channel is to point out what's actually going on and to, put things in perspective, put things in a perspective that gives people a sense of realism. As it pertains to this, that means I do believe there is significant potential that we could recover from here and continue on. However, I'm also preparing my portfolio in a way such that, I know that there are major, major economic risks out there right now, and I'm preparing my portfolio for that. To not do so would be irresponsible. Okay. Remember, the key points here are, in general, market cycles will likely lengthen in time. However, any individual market cycle does not have to lengthen in time simply due to outside factors influencing the market that could send it down to lower prices, $30,000, for instance, for a protracted period of time, a year or two even. Nothing is to say that just because we believe that market cycles will lengthen as time goes on, which I do, that this one must necessarily lengthen. And I think that is a serious way in which this theory is being misconstrued or misunderstood. So that's going to be it for this one, guys. If you guys like this type of content, hit like and subscribe. And until next time, as usual, see you.